As with all of the other corporate structures, I hear this all the time, but it's my money. No, not the way you set this up. Now, you can potentially put a stock account or fund inside a family limited partnership. It's owned as part of a business, or it is a separate investing business. But you're not going to still get much of a discount on that end of it, because all stocks are considered almost as if they were the same as cash. Right. You also don't want to put your personal residence in there. Again, it's not in business, and personal vehicles don't go in. Now, you can try to do something a little clever. Set up an LLC, put your vehicle in it, and then lease it to yourself personally. And then in that event, it is an LLC. So we'll talk a little bit more about potentially dividing up and fractionalizing things in other business entities inside a family limited partnership that can actually provide bigger discounts. All right, so everything in the family limited partnership must be run as a business. Right, you've got to have annual meetings and recorded meetings. And this really does kind of come down to proof. If an LLC or a corporation is going to get broken in a lawsuit, the biggest reason is they weren't really treating it as a separate business entity. It was almost as if it was an alter ego for you as an individual. They're going to try to get past that shield of that corporate protection in order to get to your personal assets in the event of a lawsuit. And these regular meetings and documentation of these regular meetings is going to just help reinforce that, yeah, this was done in business. You're going to have separate accounts for the family limited partnership versus your personal, separate accounts for your LLCs and corporations inside those entities and with the family limited partnership. And as with all of the other corporate structures, I hear this all the time, but it's my money. No, not the way you set this up. How many people here have heard that from clients, like especially if they move stuff into an irrevocable trust, they're trying to get it out of their estate, but it's my money. Well, no, it isn't, not anymore. You've given it away. You've put it into this corporate structure, so it's under the control of those corporate structures. All right, so what happens if you don't keep those separate books for each of these business entities? There's every chance they can just simply be disregarded. And that's not just in a lawsuit, that's also potentially for taxation purposes. So yeah, keep that documentation. Same thing, what happens if you take business money to put into your own pocket without recording it as some kind of distribution? What if you use personal assets to pay business expenses, again, just enough to disregard that as an entity? All right, now, as an aside, for family limited partnerships, like I said, these are really good tools, but I won't do these for clients anymore unless there is an accountant on board who understands taxation of family limited partnerships, understands just business taxation in general, and understands trust taxation. One of the most frustrating cases I worked on was about 2 years ago.
If you think it's important for educational videos like this to get out there, then please help us out by subscribing to the channel.
Yes, everybody was on board with all of this stuff. Yeah, my accountant knows exactly what's going on. All of my business entities are C corporations. And it actually was two brothers that owned most of these corporations, and the son was a partial owner on a couple of the other businesses. And so, yeah, some of them were split 3 ways, some of them were 2 ways. Yes, I'm doing this family limited partnership. I like this idea, it's fantastic. My accountant understands what's going on. Accountant then informs me, no, all of these entities are S corporations. You cannot put S corporations into a family limited partnership without blowing up the S corporation status. And so this did not go forward as an entity, but we were far enough along the way that this really should have had the account in there from the very beginning, despite what my client told me. The other thing is this particular accountant said, oh yeah, I understand trust. But then they said, well, you can't put S corporations into a revocable trust because that destroys the tax status. No, it doesn't. No, it doesn't. So again, finding that accountant who understands exactly what they're doing becomes an integral part of making sure not just that this gets set up the right way, gets funded the right way, but then the taxation happens and all the recording happens properly all the way along the way over the years. All right, so limited shares can be gifted or sold to beneficiaries at discounted rates. So what that essentially means is because you have a valuation that these shares really, if it's 1%, it really doesn't represent 1% of the value of the assets because of all the other restrictions. Here's what the actual value is. Now that could be an accountant, it could be an appraiser. It has to happen at the time of gifting. And we'll talk a little more about that. Separating your FLP assets and personal assets for liability purposes. Separating LLCs and corporations within the family limited partnerships can also insulate the other business entities from a lawsuit against one of them. Now, it's been a while since I've been to law school. I don't necessarily remember the exact cases that popped up. I suppose if I started reading some of them, I'd remember, oh yeah, I did remember that. The one that I remember from corporate law was a New York City taxi cab case. Is this ringing bells for any of the attorneys out there? Yeah, New York City, there was a big cab company. They had a lot of vehicles. Let's just say it was about 300 cabs on the road, and there was somebody, I think they were like a major sports player making millions of dollars a year, and they got injured in an accident. And yeah, it was the fault of the taxi driver, so they wanted to sue and get as much money as possible. Well, the way this company set things up, it wasn't just the one company. They had 100 LLCs, each LLC owning 3 cabs and a checking account. They were only able to get to the assets with the 3 cabs and the checking account. Meanwhile, the other 297 cabs are on the road, still making money for the overall company. And that liability shield held. So this is something that I end up discussing a lot with my clients, not even at the family limited partnership level, but just the LLC level. All right, I have 3 rental properties. They're all in one LLC. I'm ready to buy a 4th. All right. Maybe we should look at doing another LLC, transferring one and buy the new one. So now you've got 2 LLCs because you're insulating one set of them to the other. Or maybe if you want to do this and really insulate liability, we should go up to 4 LLCs. Yeah, that means there's a little extra accounting. Yeah, it means you're paying your $200 a year to the North Carolina Secretary of State to do it. But that may end up in a big lawsuit. It's the best insurance you're going to have. So separating those out, even within the family limited partnership, is going to distribute that liability among those different LLCs for whatever each individual business is doing. All right, and so another benefit, the shares are valued on death for estate tax purposes, not the business assets. And because of, again, all those discounts, it really could be a lot less. All right, so how do you shrink the value for gifting? So if LLC 1 holds a rental property worth $500,000, LLC 2 owns a rental property worth $500,000. There's a C Corp, it's got business assets worth about $1 million. So the value of a 1% limited partnership share, well, it is less than $20,000. And let me see if we're getting there. Yeah. So the valuation of the limited interests are made at least annually. You should have this being done as a process. What are the values of these shares based on the business assets at the time, about every year? But certainly, even if you're not going to do it every year, at the time you're going to gift these limited shares out to the kids and the grandkids, you want that written valuation to go in. Now, what is the discount? All right, this is a starting point. And this is very highly dependent on the business assets that you've got in. But if you start thinking 30%, all right, that's a decent example. Now, the reason these family limited partnerships were getting hammered by the IRS many years ago is because people were kind of starting with 60 or 75% discounts and just saying, yeah, obviously it's worth a lot less. It's worth only, it's only worth 25, 30% of the value of the business assets, and that just was not justified. So there was one attorney who was, they ended up getting this reviewed by the IRS, but they had all their documentation for 30%, and that's what they put in. And the reviewer, just as a matter of course, was auditing all of these particular years. And they walked in, and the auditor, without even looking, said, the most you're gonna get is 35% off. They said, okay. That was actually 5% off more than what they were claiming because they stayed within the lines. It's like, wait, you just audited us, you were coming down hard on us, but you gave us more? All right, we'll take it. That was it, meeting ended, we agreed, signed, and they left. They got into the car, the attorney and the client, they just looked at each other. They did just give us more, right? Yep. Don't say a word when your opponent is burying themselves, so